Hello, welcome back to my channel. My name is Toof, and today we will be looking at a different company, different type of business, but always learning together. I focus mostly on this channel on micro caps or small caps that have a good, let's say, fundamentals, but also have possible revenue growth over the next coming years, and mostly companies that provide guidance so that I can actually develop operating model and provide a potential share price to the community. The ticker today, the company is Build-A-Bear Workshop. You probably know if you're in US or in UK. And the ticker is BBW, trading on a New York Stock Exchange. Today I'll be doing a stock analysis based on Q1 2022. And share price at the moment is $19 with a market cap around $300 million. Build-A-Bear, so obviously they've been very famous over the past 25 years now, celebrating the 25 years anniversary this year in 2022 by building brick and mortar retail locations where you can actually create your own furry friend or let's say stuffed animal. So for example, this is an extract from their website today where they are showing like the latest model that are trending. Basically, they have like I think a bit more than 400 stores, and most of them are located in US and a little bit in UK, and the rest is spread all over the world. They have different type of business model for these stores, but the most common is a corporately managed store model. Okay, and you can see that actually in 2021 the average EBITDA was amazing, around 28%. This is a very strong margin. Now regarding the vision that they have, obviously COVID phase has made them think about their strategy, and maybe they had to adapt to the environment. And obviously the digitalization was point number one of their transformation. They also developed their omni-channel, so now they are like present on TikTok, Instagram, not so much on YouTube. But anyway, this is like additional potential access to new customers, and thanks to that, in 2021 it was really working. So I think they're going in the right direction. 2022 actually has the same targets. Again, digital transformation to drive growth, use the omnichannel efficiently, and then after leverage the financial. Now, before going to the DNA cards and all the metrics, I'd like to also to give you a few extracts from the Q1 Conf call, so that we have a feeling about the management. How does it taste, you know? So just a few points now here, like I was mentioning, for example, a strong growth in Europe, which is actually a business that is not completely developed these days, so potential new addressable market. They also confirmed that they had a positive momentum for Q2, which is very strong for us, because if you're an investor, you want to be sure that, or at least comforted that the next quarters will be trending in the right direction. Also, they are mentioning that they were updating their website for enhanced experience, so it's part of the digitalization program. I have to say that the website is not the best, not the nicest, not the most, let's say, interactive or user-friendly, so I'm very happy that they mentioned that in their conf call. So it's going to be good for by the later this year. Also, the number of shops they were planning to open was around 15 to 20 over the next 2-3 years, but actually they decided to open 20 right now in 2022. So this is a strong bullish point, meaning that actually they realize that it's profitable, that they can generate good EBITDA margin, so that they don't have to wait for 2 or 3 years. Possibly also it means that they have enough cash to start investing. Again, another point from the CEO or the CFO, I think, comforted the May results. So basically, basically I think we are feeling more comfortable about giving the full year guidance on the results that we've seen so far. Also, the parties in the shops, retail stores, have been restarting. It only represents 5% of their total revenue, but still, it's trending in the good direction. And the final words from the CEO, again, comforting us in the next guidance that I will share with you on the next slides. And they say basically, our company is well positioned to achieve the growth anticipated in the annual guidance shared this morning, and to achieve our broader long-term objective. That's it. So now let's look at the metrics. As usual, we're gonna start by defining the enterprise value in order to identify the yield of the company. So if you look at the balance sheet, they have $26 million in cash. They don't have any long-term debt. Here what you see as other liability is the operating lease that at the moment I will not consider into the enterprise value. So $307 million market cap for today. Remove the 26 million and it'll give you $281 million. Over the last year, they generated $47 million of net income. So if you divide this 47 by 281, you get a yield of 16%, which is quite impressive, giving you a P of around 6. Usually you don't have such P unless the company has a lot of debt, is not growing, but let's see after for the guidance what they will provide. Regarding the price to books, 1.2, price to sale 0.7. They have so that's it on the stuff. Last year they provided dividend, but I will talk about that in the cash flow statement. But first, the balance sheet. As you can see, so enough cash. They built up a lot of inventory over the last 4 quarters. Reason being is possibly as for the supply chain, so they try to build before running out of inventory. However, actually the revenue in the quarter is around $100 million, so the total inventory is actually still less than the revenue of 1 quarter. Plant property equipment, they still have a lot, owning a lot, $119 million. It's actually decreasing slightly. And yeah, on the other liabilities, that's the only point I still need to dig a little bit more, but yeah, these are operating. Regarding cash flow statements, as you can see from 2019 to 2022, so here the fiscal year for them is just 1 year ahead. So actually 2019 will correspond to 2018, and for example 2022 corresponds to last year. They've been generating constantly positive operating cash flow, even during the COVID phase, which is actually 2021, their fiscal year. And actually, this is showing that even a retail store company that actually would have been impacted the most, they managed to still stay profitable and also invest into their capex. So beautiful. And this is here where you saw in 2021 that doing their digitalization, they increased so much their operating cash flow. This was the strongest year. One important point that I'd like to share here regarding this part, which is actually the dividend. I'm very surprised, but they did it. So out of the $28 million they generated on the operating cash flow, they reinvested $8 million in capex, but decided instead of saving money to provide a one-time special dividend to the shareholders of $20 million. I'm a bit surprised by this strategy because usually, okay, if you want to grow, keep your cash and reinvest it later or do a buyback if the stock gets low price. Another point, so at the moment they have not released their 10K, their 10Q, so I cannot see really yet the cash flow balance for the first 3 months. But what I can say is that they initiated a buyback, and that's the reason why the share numbers has decreased by 4%. Now regarding the income statements, so here is like all the gross margins, very steady, 52 to 53%. This is rock steady. But based on the revenue, you will see that the net income changed from 7 to 12%. Here you can already see the effect of operating leverage, because whenever the revenue increase, their margin also on the net income increase. As I mentioned, the Q1 also was one of the strongest in the history of Build a Better Workshop, so that's actually a very good sign for 2023 fiscal year revenue beat. And regarding the capex, I already mentioned about that. They invested 8 million, but the depreciation is around 12. In the total equity map here, they had actually, they are positive in terms of retained earnings. So in total, they accumulated $39 million of of real cash flow over the last years, so it's good. And the last one is my favorite one, is regarding the operating leverage. So what do you see here is from 2018 to 2021, so they had like a dip, obviously, in 2020 for the COVID phase. But what is amazing is that they managed actually to rebound stronger on, let's say, last year, stronger than 2019. At the same time, they increased the operating leverage, so you can see that the gross profits increased even more than the SG&A. So fantastic. They managed to adapt to the situation. They didn't lose money, and actually they came back stronger. That's exactly what I want for a company, and it's actually a very promising element when you will see the guidance. So let's switch to the guidance. Just for information, so they were reporting $411 million on fiscal 2021. So I will just highlight here so that you have a better visual. They get basically for 10% revenue increase, and also maybe a 12% income increase. And this is what we're going to use in our operating model to estimate a share price for next year. Also, a very important point is that the company actually commits even more on these numbers because they already consider taking into the inflationary pressure as part of their guidance. So what does it mean? It means that they cannot come back in the middle of the year and just later down the year just saying, oh look, the inflation is penalizing us and we will not be able to reach the guidance. Here they are showing that they are already anticipated and that the numbers can be actually more reliable. Also, one very important point is look at the revenue, the management forecast. Every time they guide for something, for the last 8 quarters, they beat on the revenue and they beat on the EPS. Meaning that the guidance that I was showing here might actually be conservative. So kudos to them because really it is exactly what I like under promising management, so that we can always have the good surprise. So now let's start with the valuation estimation, and as usual, same process as I did for Catalyst Pharmaceutical, SMSI, Charles & Covell, Crocs. Now for BBW, I will do the same. So from the revenue, you have all these specific cost of product OPEX. From the net income, you divide it by the number of shares and you get an EPS. Then from the EPS, you multiply by a specific PE ratio and you adjust the final share price with the cash or debt that they still have in the balance sheet. As a guidance here, for the first valuation, number 1, I will use the average guidance. So they were guiding between 440 and 460, so I will use a revenue of $450 million. Same for the pre-tax income, between $52 and $62 million, I consider 57, which is in the middle. They mentioned that they had a 25% tax rate, which gives us a net income of $42.7 million for this year. Divided by the number of shares, which is 15.7 million, and you end up with an EPS of $2.7. Now, again, here it is where the art meets the science, is what PE ratio would you apply on such company? Usually the retail store company have a very low PE because obviously they are not so profitable since COVID time. But obviously this one has been transforming into digitalization, like into omni-channel marketing company. So it's not only a retail store. So I would say that for revenue that is actually going to increase by 10% at least, and a very profitable company, I would guess that a P ratio of 10 would be something acceptable. From there, you multiply, 2.7 multiplied by 10 is $27. The cash in hand, they have $26 million. So if you divide by the number of shares again, you have $1.6 per cash per share. That you will add up to the estimated share price of 27. My final share price here for a P of 10 is 28.6. Now, I prefer to give you a range of targets rather than just one operating point. So that's the reason why I just made a valuation number 2, which is actually changing. I just changed the PE. I consider maybe a PE of 12 because for me, it's a growing company. It's a company with good operating leverage. They deserve maybe a higher PE. I didn't go to P20, okay, so I'm very conservative into the window that I want to share with you. But basically the share price will be $32.8. So you have between 28.6 for a P of 10 and 32.8 for a P of 12. Now let's look at the conclusion and then actually summarize it before we go to the chart. First, the company is actually has a very strong brand. Okay, I'm French, so I'm not very familiar with this name, but obviously in US and UK it's very popular. This will give them always an advantage whenever they do their digitalization because they don't have to promote their brand, it's already there. Also, profitable company, they have a clean balance sheet, they have a great operating leverage that they were showing, and they were showing that they could actually rebound from the COVID phase, which is fantastic. As I mentioned, they have a great yield today of free cash flow, 17% or PE of 6. What does it mean? It means that the share price will not be able to drop to $10, so your risk in the risk-reward equation is actually very low. Buyback is ongoing. Also, they have a program. $25 million actually was the complete plan. They actually executed $14 million, so still $11 million left to go. That will provide again another, let's say, safety margin in terms of in case the share price is going down, because they're going to start buying back again. Conservative management, also that's a very important. You need to trust the people, and when the management beats the revenue and the EPS for the last 8 quarters, you can say that, okay, if they guide for something, you know they're going to send back and you're going to only end up with a good surprise. Also, the earlier expansion on physical footprint that was supposed to be for 2023 and only 15 shops transformed into 20 shops by 2022. So actually it's like showing that they are very bullish in terms of expansion. Also, they plan to improve their website. This is part of the digitalization transformation. As I mentioned, I'm not very big fan of their website. I know there's a lot of room for improvement, and I'm happy to see that they're going to do, like, for example, this 3D workshop page that is not working yet, but it should work anytime soon. This year also a little additional catalyst to the list that I already mentioned is that it's their 25th anniversary, so they will launch very special editions of stuffed animals and toys. So this can only help them to promote like some new models and obviously generate a little bit more revenue. The workshop parties have also been ramping up since March 2022, they said. So it's very interesting in terms of advertising here, because when, for example, this is a kid's birthday, they're going to bring other friends, and these friends are maybe not, let's say, familiar with buildabear.com workshop, and they're going to start saying, oh, that they can build a bear, and then maybe this will be actually a great strategy to acquire new customers, even though it doesn't, let's say, represent a big percentage of their revenue. Also, another interesting catalyst is that by end of June, they will be added on the Russell 2000 index. So they are now with a market cap valuation of $300 million. So they qualified to enter into this higher index. And obviously, it will give a possible additional, let's say, exposure for more investors or funds investing. I think that's it for the pros. We have 10. That's good. For the negative side, just one thing that I just observed is that the CEO was selling 7% of his total shares recently, but still owning 3.3% of the total float, which is equivalent to $10 million. It's not a red flag, it's not an orange flag, but just something to mention. Also, the recession, consumer habits, and inflation could impact their margin, but as I mentioned in their guidance, they already took into account, so not a red flag, not a yellow flag. And also the other liabilities, operating lease to consider that I didn't mention or didn't include into the EV, enterprise value, but still need to see how it would impact the potential free cash flow generation. And the last point that I didn't really like was their special dividend in 2021. I'm just wondering if, for this case, the management did the right decision. They probably did for specific reason that I'm not aware of. But basically, yeah, I would have rather kept this special dividend for later, for maybe more buyback, for basically like a more long-term interest rather than just a special dividend. Now we can go to the chart, the summarizing chart for my estimation and the current valuation today. So as of June, I think 7 or 6, the share price was $19, and here is my target for a P of 10 and a target for a P of 12, looking at the mid-range of their guidance in terms of revenue and net income. As you can see, this window, you need to put it on a specific timeline. So I just put it from March, because this is where they announced basically the last quarter of the year 2022. So you have the full year released, press release. So I just from this point to that, let's say March, looking at the different targets, this is where I put a trend, and then I put like I measure the compound annual growth rate, and basically you can potentially have a 66% annual revenue or 104% annual revenue if you consider a higher P. This type of information, actually, I will try to make a video in the next, let's say, 9 months to see if my hypothesis were right, if we hit this window. And that's the reason why I think it's good to subscribe to the channel if you want actually to follow that and have a notification whenever I put the video. Obviously, here this is a guidance for mid-range, so they could also have a lower range, which would actually give maybe a price target of 25, and if they are in the high range of their guidance, they would maybe reach 37. So obviously this window is very, let's say, tight, but I could expand it from, let's say, 25 to 30, I think $35. I think that's it. I just want to give you just a few slides regarding the operating lease from the extract from the 10K, also the inflation. So that was just an interesting point that they were saying, like basically they will do strategic price increase. And also here there was the ownership, where actually they recently, in May 31, the CEO was selling 7% of his shares, of her shares. I think it's a woman CEO. So I think that's it. I hope you enjoyed as much as I did. I think this company is very interesting in the short term, very conservative management, very promising transformation into digital. So let's look at this. Let's follow that maybe in the next 8 months or 9 months, whenever they have the full 2022 guidance. And yeah, give it a like if you're still here until the end of the video. And I hope to see you soon on the next ticker or next idea. See you soon. Bye bye. Have a good day.